If it comes back down to 10 or 14 and you're worth 25, let's say, you've got yourself, 15, $11 million exposed to 40% federal. But if you're in California, it's another 10. So you're talking about a 50% total.
Here is in the United States, the term death tax or estate tax refers to estate and inheritance taxes. The estate tax is a federal tax on the transfer of the estate of a deceased person. This tax is applied to a property or assets transferred through a will, or in cases where the deceased did not leave a will, the property is transferred based on state laws, individual state laws. And so some key points here to consider is, death tax is just another way to describe estate or inheritance tax. That's key. And then all assets that are inside of the taxable estate that are valued essentially $12 million per person right now as of 2023. There's a little bit of inflation that's kind of built in for that. But a good way to think about it is if you're married and you're worth about 25, 26 million, you're pretty much good right now. If you were to die before these exemptions are set to expire in 2026, essentially, where it's going to cut in half or maybe even lower.
Yep.
And so what does that mean if you didn't do that? If you didn't do that, Joe, it's going to be a 40% death tax, right?
It's federal.
So talk about how this has nothing to do with the stepped up basis, which often gets confused if people are doing 1031 exchanges and getting that, or just holding on to an assets and getting a stepped up basis.
Yeah. So, I mean, the bigger tax, right? If it does come back to that $5 or $7 million number, it's not very clear right now. But if it comes back down to 10 or 14 and you're worth 25, let's say, you've got yourself, $15, $11 million exposed to 40% federal. But if you're in California, it's another 10. So you're talking about a 50% total expense. And so that really is a big deal. Now, if we use a deferred sales trust and one of the things that we won't be able to take advantage of there is the stepped up basis, right? And so the stepped up basis, that's going to allow someone who has a appreciated asset, let's say a zero cost basis, 10 million, instead of having a zero cost basis, when it passes down generationally, not spouse to spouse, it's going to have a step up basis to 10. And essentially in California, a $3.7 million tax bill vanishes. However, if we put that in a deferred sales trust, that deferral just continues and continues while the note passes down generationally. We don't get that stepped up in basis. So we have to balance those decisions and talk about the pros and cons of both situations.